My name is Sam DeCourt and welcome to our May video update. Bit of a different format this month as we're joined by Mike Taylor, Chief Investment Officer, as well as Kent Williams and Michelle Lopez, who both join us from Sydney. Hi, everyone.
Hello.
Hi, Sam. Hey, Sam.
Mike, we'll get started with you. So geopolitics is a word that I feel like we talk about every single day. We go back 1, 3, 5, 10 years, it wasn't the same. Am I right? What's changed?
So what's changed, I guess, in geopolitics is go back that 5 or 10 years. I suppose it mattered for particularly if you were in a region or a country that was affected, but it didn't really matter for markets so much. They might have a short-term blip or move around, but not a meaningful lasting effect. What we've seen, I guess, in recent times is geopolitics having a major effect on markets and creating consistent and ongoing volatility and instability.
I'm curious regarding commodities, another hot topic, Mike, how your thinking has changed over recent months, recent years, maybe with oil as an example.
Yeah, I mean, if we look at oil and the recent spike in the oil prices, it's not really come as a function of increasing demand, which has potentially driven some of the other spikes in oil over the last, 20 or so odd years. This is really a supply-driven spike in price. And if we just step back a little bit from the closure of the Strait of Hormuz and look at what's happening around the world, is that countries are looking to be more energy independent than they were before because of situations like we're experiencing right now. We don't necessarily know what ally or who we can rely on to secure our energy. So countries are looking to source their own energy and rely on themselves. And that places a bit more of a upward pressure on commodity prices, not just oil, around the world.
If we think, Mike, you've been heading the PI investment team for nearly 19 years, is this environment harder to invest in, or does it create more opportunities, more risks? What's the answer?
Look, I think there was a period post the GFC up until probably 2019 and into COVID, where investing was pretty much a set and forget strategy. So, you could buy quality growth companies that had a tailwind of, they're coming from low valuations. We had falling interest rates and stable geopolitics around the world. Since 2020, we've had a lot of change, and that has made markets much more difficult to understand, to get ahead of. We've seen lots of rotations within different sectors and asset classes. We've now seen two oil shocks. We've seen a pandemic. We've seen huge spike in inflation. There's a lot going on in a very condensed period of time. I'm not going to say that it was harder than the GFC because I think that was really probably the most horrific financial conditions that have to work through. But certainly it is a challenging environment for us. To your last point, does it create opportunities? Of course, wherever there's challenges, there's always going to be an opportunity. And that's what our job is as the investment team to look out for them.
As CIO, again, so Chief Investment Officer, what are the key things you're looking at or indicators you're looking at sort of daily?
Well, politics is now, I guess, economics. Technology is very uncertain in this environment, and having a good handle on commodities is really part of our ongoing investment strategy.
Thank you, Mike. Now we're going to switch to you, Michelle, over in Sydney. You came over to New Zealand in November for our annual road shows around the country. And one of the slides that you showed at the time was the 4 key indicators that were driving the strong Australian economy and share market. But a lot's changed in the last 5 or 6 months since then. Do you want to touch back on them and talk about what's changed?
Yeah, sure. So if we do go back to November last year, the backdrop was genuinely encouraging. So as you mentioned, we have 4 pillars that we track from a macro perspective, and all 4 of those were green territory. We had strong GDP growth, full employment, inflation was moderating, and capital expenditure was picking up. So if you fast forward to today, the picture is a lot more nuanced. You still have 2 of those indicators like job creation still looking like it's blowing somewhat, but we've got GDP growth still growing, and importantly, we've got CapEx still looking like our companies are investing for the future. The two changes I mentioned, we've seen a slowdown in job creation more recently, so that is a little bit more nuanced, but the big change is really around inflation. The last data print that we had inflation running at 3.7%, which is by no means concerning, but the expectation is it to go a lot higher. And that's driven a material step change in the 2-year Treasury bond yield, and that's quite a pivotal measure that we monitor. And we've seen a fundamental repricing given the trajectory of inflation and the expectations going forward.
Can you elaborate a little bit, please, Michelle? So in Australia, our Australasian growth funds, up until sort of October last year, they had a really, really strong run, and there's been quite a meaningful correction since then. Can you talk a little bit more about the driver of that and interest rates?
Of course. So when I mentioned the 2-year Treasury bond, and just to give some context around that, the yield has actually surged from about 3.2% at the time in November to currently 4.7%. Our interest rate sits at 4.1, so there is expectations for a further 2 rate increases over the next 12 months or so. Now, that is a material repricing of rates, and what that means for us as equity investors and the companies that we're investing in is that the discount rate compresses valuations, and that's particularly the case for growth companies whose earnings are weighted towards the future. It also increases the borrowing costs for companies, and all of that is actually a headwind. We're not pretending otherwise for the small ordinaries, which is the part of the market that we're investing in. The good news from all of that is that is already now priced in. So to your point, Sam, we have seen a 20% correction from the peak back in November last year, and the market's off about 12% year to date. So going forward, there is still that expectation of 2 further rate hikes, but that part of the market does move a lot more than the broader market, the large cap, when it comes to interest rate changes.
Historically, Michelle, when our Australasian growth funds have had pullbacks, that has been followed in the next 1 or 2 years by very strong bounce backs.
Correct.
Is that what we can expect this time?
Oh, look, it's very difficult to know what to expect in this environment, but there is absolutely precedent of that happening. And I always say context is everything in our world. And if you go back to probably the most similar situation or confluence events that we're seeing today, was probably back in 2022. So back then we had Russia invade Ukraine. We had energy markets in chaos, and we also had the Reserve Bank of Australia embark on the most aggressive rate hiking cycle in decades, and that's because CPI, so inflation, peaked at close to 8%. So that's all really familiar to what's happening today. And if you go back, and you can see it on the slide here, we have the performance of one of our funds, which is the Emerging Companies Fund, and you can see the return that fund has generated over the next 12 months and over the next 24 months. And in fact, every one of our funds that we run had very similar return profile, significant outperformance on an absolute, but importantly over a relative basis as well. And again, it's an example of when we do see these drawdowns, just to remain disciplined as investors, and it's probably the worst time to panic.
So final question for you, Michelle. What changes has your team been making in Australia to the portfolios for the current environment, but also to position for the best possible recovery?
Well, We always start from a position of entering a different market phase, and we talk about diversity of earnings drivers over sector allocations or anything like that. And that's important because we don't have a very firm view around the outcomes at this point in time. So what we've done specifically, we have reduced high valuation growth positions. So rising rates hit high valuation stocks disproportionately. So we had been taking some of that off the table. More recently, we've actually been adding to what we call growth at a reasonable valuation. So these are very high quality businesses with real earnings growth bought at sensible valuations. This sell-off has created genuine opportunities that just simply weren't available at this time 12 months ago. So that's your long-term compounders that typically command a higher multiple, but in these moments of crisis get sold off indiscriminately. And then the third thing we did was introduce hedging. This is a tool that we've used judiciously in the past. We felt it was the right tool for a period of general uncertainty, and we did that in various forms. So as early as January, we took a position of long futures in oil for a couple of our funds. And then when the war really heated up, we took them short positions over the market. We closed those early April and have participated in the recovery, the short-term recovery that we've seen over the last few weeks. But again, this is mainly on geopolitics and uncertainty. So ensuring that there's downside protection in the portfolio.
Thank you very much, Michelle. Over to you, Kent. So Kent, you know our Australasian approach well because you were previously portfolio manager of the Emerging Companies Fund. And obviously the Australasian funds are more of a concentrated, high conviction approach. Since you took over our Global Growth and Global Growth 2 funds around about a year ago, or just over a year, you've implemented a slightly different approach, and there's been a big improvement of performance. Can you just give a brief summary as to the approach in the international funds?
Yep, sure, Sam. And just to take a step back to make it clear, we've kept the same as the philosophy. So what we've done is we've taken the exact same belief system that we have always had across all the funds at Pi, and we've implemented an approach which we feel makes more sense for the global landscape. So what we've effectively done is we've catered to the fact that within global we have about 11,000 stocks to look at versus Australasia, which might have a few hundred. So effectively really systemizing that core beliefs that we have. The way I'd like to explain it, I think the most simple way of understanding it is we're really doing fundamental investing at scale, and we're trying to just do that and deliver more consistent returns in the global funds, which so far, in the first 12 months we've achieved, which is positive.
Kent, the key objective with investing is to beat the market, and both of these funds have outperformed their indexes over the past 12 months. What have been the kind of key drivers of that? Has it been a regional overexposure, or has it been more exposure to a particular sector?
It's been a bit of both. So from a regional perspective, the strongest region has been Asia Pacific, and that's come from two aspects. It's been overweight gold in Australia, which we also do have some exposure to through Canada. And then the other part is sort of leaning into this AI hardware thematic that we've really seen in the last 12 months. A lot of interesting companies coming out of sort of Hong Kong, Taiwan, South Korea. So that's been a really big opportunity. And why we've lent into that over sort of the US is really valuation dispersion that we've seen. Very similar businesses, similar thematics, similar earnings growth, just trading on much more attractive valuations.
Ken, you shared a slide with the team last week that showed that for a fund to perform, you don't need every single stock pick to play out. We'll bring that slide up now. Can you talk to it, please?
Sure. Okay, so what you see here is every single stock that we've held and purchased throughout the last 12 months. And what we're showing is the actual return that we've achieved from each one of those stocks. So it's not the share price return, it's the actual return we've achieved from either buying and holding it or buying it and selling it. So the share price could be higher or it could be lower. And what each little bar represents is that's an individual stock. And what's really important is the height of the bar represents the level of return that we've achieved. And obviously we've sorted that highest to lowest. So the key takeaway from this slide is that you don't need to rely on one or two winners. It's about getting that shape right. So we have more winners than losers, and that more importantly, the winners are larger than the losers. And what really sort of excites me about this chart and why I like to show this is it's not just one or two stocks. You can see the huge solid number of companies that have delivered over 50% returns, and there's no company that's delivered worse than a minus 50% return. So getting that consistency and that breadth.
Mike, back to you to round it off. So there's a lot of talk in the industry about active versus passive. We talked a little bit earlier about the environment we're in, whether it's easier or more difficult. And pleasingly, our active approach has really worked on the global space in the last year with Kent at the helm. Can you maybe talk to that a little bit to wrap it up?
Yeah, I saw a stat today actually, which I did share with Kent, which is about 80% of New Zealand managers who active managers on a global scale have underperformed in the last year. So it's quite a staggering fact. Normally you'd expect it to be closer to 50-50. Pleasingly, our approach to active management through both the global strategies has not only beaten the market, but we're also significantly ahead of our two peers. So you see on the chart there, two large NZ active fund managers have underperformed and really struggled in the last 12 months. And that's because of the factors I mentioned, which is the geopolitics, the volatility, and also the rotation within the market. So the market rotating out of software companies and into AI hardware. And if you're a portfolio manager and you missed that globally, you would have really struggled in the last 12 months. Importantly for all of our investors, not just in those global funds, but for our KiwiSaver funds, that's seen our KiwiSaver fund catapult back up, with a growth one catapult back up to we haven't had the official numbers, but we think it's close to number one in the last 12 months. So very happy with that.
Okay. Mike, thanks for joining. Michelle and Kent, thanks for joining from Sydney.
Thank you, Sam.
And more importantly, thank you very much to our clients and audience for tuning in. And we're here if you want to talk, and we look forward to seeing you next month.